watching. We're now on to a fantastic presentation from Alan, who was on this panel, Alan Gelder, SVP for Refining, Chemicals and Oil Markets. And it's called Refining Must Do Better to Provide a Platform for Future Adaption. So over to you, Alan.
Hello, everyone. I'm Alan Gelder, SVP for Refining, Chemicals and Oil Markets at Mackenzie. As global downstream SME, my focus is on ensuring our commercial research remains relevant to our clients. Key message for the next 15 minutes or so, really today, is that the market tailwinds that refiners have enjoyed over recent years have eased. Refiners need to improve their performance so they're going to be able to invest to adapt for the energy transition. So look at this chart first. Stop focusing on the chart on the left-hand side. Similar format. The shaded area is the 5-year range, and then we're showing sort of performance for 2023 and then 2024 and 2025 in the two different coloured blues. If we focus on the chart on the left-hand side, what you can clearly see is that refining earnings were at unprecedented levels in the recent past. That was all around 2022 with the Russia-Ukraine conflict. The purpley line is the performance in 2023. You can see that it started off the year strong and then had a relatively much weaker summer and then strength in the third quarter, and that was really around market concerns that there was a diesel shortage in Europe. 2024 is that light blue line, and what you can see is that actually it's been much lower than 2023, and actually typically around or at or below that five-year average. And actually that global refinery composite margin on a weekly basis is back to pre-pandemic levels. So why has this happened? Geopolitical tensions remain quite high. What we have seen sort of fundamentally is that refinery capacity additions on non-refinery sources of supply across 2023 and 2024 have outpaced demand growth. Now, refineries don't start full operations immediately afterwards. There's a period of ramping up, and we're witnessing that with the Dangote facility in Nigeria and also with Dos Bocas in Mexico. And the ramp up that we're expecting from those facilities means that actually, as we look across 2025, we're not really expecting refining margins to strengthen from the levels they are now, given this greater amount of capacity that's coming available, despite sustained oil demand growth through 2025. The other feature is just how the refining market has adapted. 2022, we had the Russia-Ukraine conflict, we had sanctions, we had basically introduced trade inefficiencies as Russian volumes of distillate that traditionally went to Europe meant long haul to Brazil, Russian crude, and typically over to Europe, went to it all the way to India, and these extra freight rates introduced trade inefficiencies. The market has adapted, so we now, given the challenges OPEC is facing in putting volumes back into the market, there are over 10 VLCCs that have been cleaned, that have gone through moving crude oil between regions to moving middle distillates, diesel and predominantly diesel from the Middle East to Europe. So the disadvantage of sending ships all the way around Southern Africa has been mitigated by the very large parcel sizes that we've seen. So it just shows you how flexible and adaptable the refining system is, but it's at a point now where we're back to pre-pandemic levels, and those margins aren't expected to ease during 2025. So performance needs to improve. This is another way of showing there is a strong need for performance improvement. Wood Mackenzie has terrestrial infrared cameras looking at many facilities in Europe and virtually all the ones in North America. And so through those, we can see whether the key processing units are operating or not, as to whether they're basically hot or not. And that enables us to produce a reliability index where we look at the availability of the refinery units compared to sort of the time they should be available. So it enables us to assess the degree of unplanned outages. We look back and assess the profitability of every site over 50,000 barrels a day. And so by virtue of the lack of availability or poor reliability, we're able to assess the commercial impact of that unplanned outage, just in terms of margin loss. And what you can see is there is actually a fair number of sites within Europe where the unplanned outages cost tens of millions of dollars, and that is excluding the costs associated with actually fixing or remediating the cause of the unplanned outage, be it equipment failure, being fire, etc. So this is a very specific way of saying there are a whole number of sites within Europe where there is a significant opportunity for improvement in commercial performance. We've tagged it to AI because it basically suggests there needs to be a structural improvement in maintenance capabilities and the ability to predict when equipment needs to be maintained rather than reacting to it, which is much more effective at minimizing maintenance spend and improving commercial performance. So the European refining industry, there are many sites that have significant opportunity to do things better to improve their commercial performance. And we believe there is a need to do things better if they're going to have the capability to invest, to adapt. But our medium-term thesis is actually one of a rising tide, arguably lifts or woes. So our outlook is that oil demand growth continues. It's broadly sustained. We have global oil demand growth peaking in the early 2030s, and the chart on the left-hand side shows the sort of impact of the energy transition on the different fuels. The light green, so the second one down, is gasoline. That hits a peak late 2020s, early 2030s, and declines quite markedly. That's because we see passenger cars being at the forefront of the energy transition around electrification of passenger cars. The line above it is for diesel gas oil. That is more resilient or less impacted by the energy transition because it's more driven by fuel efficiency, and heavy-duty commercial trucking is much more expensive to abate and decarbonize. The purple line that shows a strong growth is actually petrochemical, is LPGs and ethanes, NGLs into petrochemical feedstocks. We see that growing strongly as those components produced from upstream gas production and also crude production need to clear into petrochemicals. But if you aggregate it all, you can see that actually oil demand peaks in the early 2030s and the composition of oil is changing. The composition of oil demand is changing, sorry. If you look at the middle chart, focus on the yellow, that is the average utilization rate for the global refining system. And what we have is that utilization strengthening from where we are now to reach a broad plateau in the early 2030s. And that basically improves the throughputs and the margins across all refining sites globally. So global utilization improvement and strength should improve refining margin performance. But once we've hit a peak in oil demand and how the region behave differs. So Middle East, looking at the chart on the right side, crude runs remain broadly stable. The top line, Asia Pacific, again, crude runs remain broadly stable through the 2030s into the 2040s, because it's only in the latter part of the 2040s does oil demand in that region starts to decline. North America's a bit of a broad plateau before a decline. The grey line is that of Greater Europe, which shows that actually the crude runs in Greater Europe are going to decline the fastest. That's because the region already has weak oil demand growth, and demand is going to decline, but actually the assets are competitively weak, which means they suffer the drop in utilization first. sort of mentioned previously, we analyse over 500 sites, and I think producing over 50,000 barrels a day. And here we're just putting it on a 2x2 matrix to look at which assets we see as being the most sustainable in their current form. And with the axes we use is their net cash margin, which is EBITDA per barrel, how much money do they make? So how much cash is being generated, and the chart on the y-axis is actually their scope 1 and scope 2 emissions. So to what degree, how intense are their emissions associated with their operations. Where refiners want to be along this cohort, that's Europe, North America, pulling out PAD 3, and Latin America, is they want to be in the target quadrant where you've got above median earnings and also below median emissions. You can see that a number of sites within North America, particularly those in PAD 3, are in that position. Where don't you want to be? Where would you, in terms of processing crude oil into fossil refined products? Well, that's below the average earnings and above those median emissions intensity. And if you look at the colour of the dots, what you can see is actually that is where the vast majority of European assets sit within this cohort. And so different sites, this matrix gives us the opportunity to assess what sites need to do to improve. If it's high emissions, focus on decarbonisation options. If it's low earnings and high emissions, then actually, are they a threat of closure, or are they going to be divested out of a portfolio? But it clearly shows that European refiners out of that cohort need to be amongst the first to adapt their operations and their business model. If we look at the first classic for that, we kind of mentioned it briefly, we see petrochemicals as a key demand sector, and the demand for petrochemical feedstocks continuing to grow despite even when transport fuels are in decline. We model all of the integrated sites globally. There's over 200 of them, and we just coloured them by region. And this is showing the uplift from petrochemicals in 2023. What's clear is that even when the petrochemical market is very weak, which it was in 2023, there is the opportunity for petrochemicals to add value. The sort of insert charts show the value of petrochemicals against their refined product feedstock for each of the key regions, and it clearly shows that Europe is amongst the most advantaged for here. So this tells us that integrated refinery petrochemical sites in Europe are likely to be sustained. It does suggest that European refiners, if they can, should consider material petrochemical integration as a potential survival means. That is a challenge in Europe, given its regulation and various other factors. So what we're seeing is Europeans pivot to alternatives, and the alternative that they are focusing on are liquid biofuels. So various regulations in place that require a reduction in the carbon intensity of the fuels that are being consumed, be that road fuels, gasoline, diesel, or be that jet fuel. And for road fuels, limitations on how much ethanol can be blended into gasoline, which means further decarbonisation of road fuels requires more hydrogenated vegetable oil and renewable diesel, which is what we're showing on the chart on the left-hand side. The big opportunity, which is very much policy-driven, is the opportunity to supply renewable aviation fuel, sustainable aviation fuel, across the region, across sort of Europe, North America, Asia Pacific, with Europe having the biggest opportunity volumetrically. And if we look at the margins, and here we're just really focusing on renewable diesel, which is sort of the lowest cost source of liquid biofuels. If refiners can secure the right feedstock, the switch towards more processing of waste oils and fats into the conversion of hydrogenated vegetable oil or renewable diesel, we believe to be potentially very attractive. The challenge very much is it is policy driven and securing the feedstock that is compliant with the necessary regulation. So if we summarize, refining margins return to pre-pandemic levels look to stay that way for the next year or so before a rising tide lifts all boats. We believe AI provides the opportunity to improve commercial performance, notably reducing unplanned outages. From the early 2030s, regional crude runs decline in Europe, in part due to their weak competitive position, which is in part due to their bearing the cost of carbon emissions. Assets to survive need to be competitive in terms of earnings and emissions. How can they shift what they're doing? How can they add value? Petrochemicals is certainly one. It improves the competitive positions, with European sites being the most advantaged. But tightening decarbonisation targets requires biofuels to take an increasing share of transport fuels, with Europe providing a key opportunity for sustainable aviation fuel. But a key point to remember with all of these things we talked about is policy risk is quite key for any renewable project. With that, I'd like to thank you for your time and see if there's any easy questions that you want to fire my way. Thank you.
Thank you very much, Alan. Interesting what you said about the reducing of outages. And I think I like that, again, the correlation you had between, I think, the acknowledgement of how technology potentially could help, because where you've got the structural improvements that are needed for maintenance capabilities, I think you sort of intimated in your presentation that there's a lot of improvement that can still be made commercially. And that's very interesting. So I think from one side, you can see how technology can be a big enabler for that, whether it's downtime, outages, predictive maintenance, AI, and using all of this to actually make a refinery commercially viable, even not viable. It's also another point, what you just said at the end, actually very good, about the regulation. I think there's a key theme when it comes to decarbonisation and energy transition, and I mentioned this in my opening remarks, is government regulation and policy, and obviously that is a key driver to get things started and maintained. And I think we are dependent on that, whichever country we're in. I think that's a really important part of where this path is going to get to. So thank you very much, Alan. Brilliant presentation. We're now on to a quick networking break. Back in 10 minutes with a brilliant session on cybersecurity, one of my favorite topics, actually, when it comes to anything oil and gas or downstream. So we'll see you in 10 minutes.